Hi, Clark Howard here with a special edition of Ask an Advisor with Wes Moss.
Hey, Clark Howard. Who's the advisor, you or me?
You are. And I got to tell you why we're here. This is really funny because Wes and I both have very strong opinions about investing, but he is a professional. He is an expert. I am an amateur at it. Not really, but we approach it from very, very different styles. And Wes, I got to tell you, we even did a poll on social media, and our listeners and viewers so badly wanted you and me together to address two topics that we have confused the daylights out of our common audience, our shared audience. You know what they are?
We're not supposed to be confusing people.
I know. That's why we're here now.
Fault. That's probably my fault.
To try to take the fog we've created and see if we can lift that fog, or if we even confuse people even more.
I don't know. It could be the latter.
Well, let's see.
So what is the fog? What do you think the main confusion is?
So first, the alleged overvalue of the stock market.
Okay.
And then the second is private equity inside 401ks. I have been so unbelievably negative on this. I mean, like just trashing it. I trash private equity anyway.
Yeah.
But private equity being inside 401ks, I'm like, could they come up with a worse idea? And then you do a podcast and YouTube show about this would be so fantastic to have private equity inside 401ks and it's coming.
Okay. See,
no.
You're so black and white. You're right. I think it's a good thing.
But see, that's how our listeners and viewers that we share, they're like, wait a minute. Clark just said blah, blah, blah. And then you're saying, yeah, this is going to be wonderful. And so I want us to address these from our two perspectives together and see if we can lift the fog that we have jointly and separately created.
Okay.
What do you think?
I think that's a really good topic. I love this topic.
Well, let's start with the stock market.
Let's start with that.
Okay. Stock market overvalued by a huge amount or what?
There was a economist who is a very skeptical economist. His name is Mohammed Al-Arian. And he was on this week.
Is that how you say his last name? Man, I read quotes from him all the time.
What do you call him, El-Areen?
I don't know. I look at it. It doesn't sound like that when I think of it.
Yes,
but he's really brilliant.
He's brilliant, and he's a pretty skeptical guy, too. He's not a pound-the-table bull type person, meaning some analysts, maybe Ed Yardeni is an example, who's, by the way, been mostly right most of his career. You almost know when Ed Yardeni comes on, he's saying the market's great and it's going higher. The market's great, it's going higher. Mohammed Al-Arian doesn't do that. He is very skeptical and he's very, very cautious typically about the market. And he was asked the other day about, are we in an AI bubble? Is AI creating a bubble? Is the stock market in a bubble? So talk about a confusing response. He said this. He said, yes, we're in a bubble. We're in an AI bubble. But he said it's a rational bubble. Can you believe that? From Mohammed Al-Arian, he said we're in a rational bubble. There's no such thing as a rational bubble.
Right. So let's go back in the Wayback Machine, 25 years.
Yes.
A lot of our listeners and viewers were not thinking about investing. They may not have even been born yet 25 years ago. And we went through the dot bomb, bubble.
I remember it well.
And the more a company lost in quarterly earnings, the more their shares went up. And I kept remembering, and it's where this whole phrase, but this time is different, became such a buzzword on Wall Street. And, those shares kept going up and up and up and up. There was something called Webvan.
I remember that.
And Pets.com, among others. And so they were going up like a rocket till it ran out of fuel. And then what happened?
Straight back down to earth.
Yeah, and people just got wiped out. And so there were all these analysts then in the late 90s saying, yeah, well, this time's so different, and this is such a different thing with this .com thing and this commerce that it's just going to keep going up. And,
Forever.
don't look at any traditional valuation measurements because it's different. And we're not hearing the same exact commentaries, but we're hearing similar kind of verbiage to try to convince investors that, yeah, it's great we're throwing these trillions at these AI tools.
Well, okay, so there's a couple of things. So I don't think it's ever really different. It's always some microcosm of what has happened before. And what happened during .com was that we had a market, to your point, where we had companies not only not earning, but losing more and more. What we're seeing in this environment is, and there will be players that are wiped off the map, they've raised capital, they're AI focused, and they're never going to earn back the money, or they're never going to be as valuable to another company to pay them for their AI technology or their version of AI. And I think we're going to see companies that just go away, just like we saw in .com. So I think that there are going to be a lot of similarities. What's happening in this environment, though, is rather than a bunch of borrowing, we have a group of companies at the top of the stack of the market that are so profitable that they actually do have money to invest in AI. And it's become almost this AI arms race. There's an article this week in the Wall Street Journal. These data scientists and AI people feel like they're at war with each other, and they're working 100 hours a week.
I saw that too. I'm like,
100 hours a week.
Man,
because they feel like they're at war.
But how in the world can a human being sustain working almost 13 hours a day, 7 days a week, never any time to breathe?
Maybe if you're in your 20s, Clark, but not at my age and probably not at your age.
Well, definitely not at my age.
Okay, all right. So what we have here in this environment, you have companies that are spending money, but they're spending their free cash flow. They're spending their earnings, and they're saying, we don't want to be left behind. And because we think AI is very real for productivity. So we're spending, as opposed to having even more massive profits, we're choosing to invest and make sure we don't get left behind. So one thing in this environment is that there are companies, and as opposed to just borrowing and not earning money and losing tons of capital, what they're doing is they're taking their massive earnings that they're using right now, or that they're gaining, and they're trying not to be left behind. Now, the irony there is, if AI as a technology turns out to be a bust,
oh, it won't be.
That's going to be a nightmare for those companies. But to your point, the odds are that AI will not be a bust. It's still, and I have this conversation every day. I think about what Walmart's doing with AI. And we've gone from this phase of crawling with AI, as in crawling like a baby and just kind of using it and seeing, oh, it's pretty neat to be able to utilize AI, to seeing, I think companies are now walking with AI, and Walmart is implementing Internet of Things, IoT sensors on every pallet they have in the country. It's 90 million pallets, 4,600 stores. And because of AI and utilizing the Internet of Things, which are just little sensors that can track almost anything, they can now track every shipment down to the square inch, and they know exactly where their products are. Imagine what that could do for efficiency. Now, does it raise...
And it reduces internal theft. Because, shrinkage is such a big problem for Walmart and other big retailers. And the IoT devices are going to reduce the amount of theft that goes out the loading dock. And
it never even makes it on the shelves.
Right. And so I mean, it's an efficiency thing, and it's also going to be a profit machine, because every item that's stolen out the back of the loading dock is money that you've got to make
up.
It goes straight from profit to loss, and that is going to be absolutely reduced. And so, I mean, no doubt that these things are going to be awesome. And so,
but will they be awesome enough to make $1 million investment or $100 million investment worth $1 billion eventually? That is the jury that's still out.
Okay, so let's go back in the Wayback Machine again to the dot bomb.
Webvan, man, I remember that.
Okay, so I remember in my TV work, I go out. And
they were Atlanta, right?
They were. I don't know where they were based.
Okay.
probably Silicon Valley, where everything back in
Emanates
.bomb
from,
happened. So I'm out at a web van facility, and I'm watching this. So try to imagine in 1998 or 9 or whatever, seeing the automation that they had in place. And it was unbelievable. And so if you don't know what this was, it was the first internet-based automated grocer. And you'd go in this warehouse and
Early version of Instacart.
and so, well, except this was all automation, because you'd have these carts that had these that were very early with the bullseye kind of thing. Instead of the pricing labels, they had the full QR thing. And they'd go down, they'd know, okay, we got to get 6 bananas. And it would go down and it would grab 6 bananas in this giant warehouse. And then it would go get 3 Honeycrisp apples and on like that. And so you had all this technology and all these companies that were what I call successful failures. Mm-hmm. They led to the e-commerce era we're in now, but how many of them actually survived and thrived? Very few. And you always end up with, in capitalism, you end up with a very small number of survivors and thrivers out of these big number of players.
And I think that's probably, I don't think history will be any different here. I think there will be thousands of AI-related companies, and there will probably be a dozen or two that really make it. And they're going to learn from all these failures.
You think a dozen or 2 dozen?
I think yeah, I do. Because
will survive as big players?
Because I think what will happen is that the Mag 7, which are the big companies in the S&P 500, Microsoft, Apple, Meta, Google, Amazon, etc., they're so giant that they will be able to find these, on a relative basis, small, tiny companies that they can swallow up quickly. So I think that the winners will get swallowed up by the big companies. And maybe there'll be a few companies that emerge and they're their own new company that we haven't even heard of, and then now they're a multi-billion-dollar company in 3, 5, 10 years from now. But I think that a lot of the little winners on a relative, and everybody's little, relative to the Mag 7, these are trillion-dollar companies. So if you think of a company that's $2 trillion, $3 trillion, $4 trillion, like some of them, Microsoft's a $4 trillion company. NVIDIA is a $4 trillion company, or close to it on both of those cases. A $10 billion company is just a speck of sand to them.
Right.
So they can, I think you'll see a lot of consolidation. But let me go to some of these numbers here, and this goes to overvaluation. The weight of just those 10 stocks, which are mostly the Mag 7, is now almost 40% of the total market. That's incredible. That's never happened.
We've never had that level of concentration.
Now, it's usually pretty high because the S&P 500 is top-heavy, market cap-weighted. It's usually in the 20% range, but here we are close to the 40% range. Again, just add up the value of the 10 companies at the top of the market, and we've never seen the market this top-heavy. You asked about valuation. Let's talk about valuation. And valuation is important because this is what we're paying per dollar of earnings. So if we pay $10 per share or dollar of earnings, 10 times that, a multiple or price to earnings multiple is 10, and that's on a relative basis really low. On average, it's been about 17 to 18 over the last 30 years, 40 years, 50 years. Today, the market in general is trading at 25 times earnings. Now, that's not as bad as we saw in the dot bomb, but it's getting closer.
Right.
Back then, we were close to 30. Now we're at 25. Now, so I think that's the bad news. And to your point, we're getting overvalued. If you look under the surface, though, and you look at the average stock, so if you don't weight the S&P 500 by size and you just weight it equally, so equal weighted, we've had a lot of great listener questions about equal weighted markets versus cap weighted markets. The market is trading at about 20 times. So 20 is a little high, but it's not extraordinarily high.
All right, so let's talk about that.
Yeah.
Because I'm index funds all day long. And so you're not going to be in an equal weighted thing. And the money so heavily is geared towards the things that have pushed the valuation so high. So in my book, here's what I worry about. The market is priced, in my opinion, for perfection. no matter how you slice it, because even if you take the equal weight, you're still a little above historical averages. But if you go to the money in the market, it's way above. Here's what I worry about. When market declines happen, it's always out of nowhere. We don't know as we're sitting here right now.
What's
By the
gonna
way,
take
it's
this
weird
market
sitting during a podcast.
That's right. You're usually standing. I know.
Yeah. Anyway, so the reality is we don't know what bolt of lightning comes in, what meteor hits the market, and then suddenly you have
a down
loss
10,
of
down
confidence.
20, down 30.
Right. And so my big fear is that people are chasing the hot stuff. They're not doing market weight. They're overwhelmingly in AI this, AI that, AI, and they're on all the, they're on Reddit, and they're on
Chat
message
rooms.
boards, and they're like really fired up, and they're so dangerously unbalanced in what they're in that they're going to get their clocks cleaned when that meteor, whatever it is, hits the market, because it's a when, it's not an if. I mean, look, the history of bear markets and corrections and all that.
So you bring up two really good points. One, there's a difference between being balanced and having a structure to your portfolio where you have some safety assets and you have some highly diversified stock assets. Even if they're market weighted, I would take at least being highly diversified in market weighted different indices, large companies, middle size, small. Where you're exactly right. Where I see people really get burned, and it's hard to just hold on for the ride, which we'll get to in a second, is when they are layering. Think about what we're seeing right now. I think the people that ultimately can get burned are the ones that are laying a multi-layer tech cake. They own the S&P 500. Well, the S&P 500 is 35 to 40% in tech already. Then they're laying on another tech ETF and an AI ETF and 3 or 4 big AI-oriented companies. And that's what happens. That's what really happens and damages investors. It's not so much the diversified investor that has to deal with a 20%, 30% correction that we need to be able to muscle through, ride through, and have the patience through. It's the folks, Clark, that you're kind of alluding to here that are layering on risk upon risk, and the next thing they know, if you were really to look under the hood, their whole portfolio is tech. And when that one sector has a big correction, it's not 20 or 30%, and it's very difficult to ride that through. That's when you get 50, 60, 70, 80% losses that are almost impossible to come back from.
And then they get burned, and they're like, well,
I'm out.
I'm out, and they don't go back in, and they miss the future. Yes. So that's what I'm so worried about, is that there's so much information available now, and people gravitate so quickly into...
They get overextended.
Overextended and overweighted. They're even doing these leverage things where they're doing 2x or more into some of these AI things. I'm worried that people don't understand that what was the thing Greenspan said like 30 years ago? Irrational exuberance. So, I mean, I want to know, what would you say to somebody so that now you can't bulletproof your portfolio,
right?
And you don't go to the sidelines, but how do you do this methodically? If, let's say, I'm a more casual investor, what should I be doing so that, correction's going to come. A bear market's going to come. It always does. What should I be doing to overcome those impulses that all the social media, traditional media, everything's like pushing people to put themselves at too much risk?
Yeah, think of it almost as the light gets brighter and more moths end up to the bulb until it cracks. And what you're trying to protect against, and here's where my advice would come in, is that I think it's hard enough for investors to stick with and stay with a balanced portfolio that's highly diversified. Again, these are just the fundamentals of investing. Highly diversified, lots of different categories in the stock section, and then a healthy amount whether that's 10% or 40% or 50% of safety assets. I could think of this as dry powder. This is not private equity, dry powder. And that in itself creates a situation where even if markets go down, you're usually going to have less pain, because the pain of loss is 2 or 3 times worse or more impactful than the joy of gaining. So we know that. So my advice is to try to limit that draconian loss before we go into the next major drawdown. And I think that means a highly diversified, balanced portfolio that will still go down in a stock market correction, but it allows you to ride through and not sell out just for the market to finally snap back, and then you miss both ways.
So we're talking about behavioral economics
This is
here,
behavioral investing.
People emotionally who say, oh yeah, I can handle it, I'm fine, I'm great, and then the market starts cratering, and the same social media and every other kind of media feeds into what becomes their panic, and they sell out and they go into hibernation.
Let me give a quick example of a study that originally started with Charles Schwab. They did a great study that looked at, I think they called it perfect timing and perfectly bad timing. So they did a study many years ago, and our team kind of latched onto this and said, this is a great concept. So we now continue the study. Imagine if you're the perfect investor and you only buy when the market is at the very lowest point, the absolute trough, which we know is semi-impossible. Let's just say you could do it, versus the perfectly wrong investor who only buys when the market is right at its peak before a big correction. So those are the two investors. I call this participation versus perfection, because the third category we look at is just leaving money in cash, treasury bills. And I want to give you a couple examples for our listeners. And this is the difference between being participating and being in markets versus being a perfect investor. So it's participation, longevity, marathon, not sprint, versus perfection and thinking you can time the market. So if I go back to, I'll do 2 quick examples. You mentioned the tech crash, so we'll do that. Imagine back in the year 2000, right, or the end of 99, year 2000, and this is when the S&P 500 fell 49% peak to trough. The peak was March of 2000, and the trough had finally bottomed in October of 2002. So it was a long stretch down almost 50%. If you had only, and we're going to use $10,000 a year here, if you put your 10 grand to work at the very bottom of the market, and you just happen to know you had the newspaper of tomorrow, you had the Michael J. Fox Back to the Future newspaper tomorrow, and you nailed it, and you put your $10,000 to work today, that'd be worth $134K. So it's up 13x. If you were perfectly wrong and invested your money, your $10,000 on the day before we started that crash, of course you would have gone down 49%. It would be worth $71,000 today. If you had been scared and just chose not to participate in markets and just put your money in treasury bills or cash, it would be worth $16,000. So terrible timing still beat cash by more than 4 times. Now, how do you ride out that difficulty? That's where balance comes in. Because to your point, so much of investing, we think of it as dollars and cents and math, but it is behavioral. And one of the very best things we can do for our own retirements is to be able to stay the course. John Bogle, stay the course. And for some people, you're able to stay the course with stocks all the way up and all the way down and all the way up and all the way down. For most families that I've seen this now over 25 some years, is that you need to have some semblance of balance for the overall pie that helps you stay the course. And that's why I think balance is so important. That's why I talk about dry powder. That's why I talk about diversification, which should try to eliminate the very real problem that you bring up, which is layering what is already working on top of what is already working so that you get a highly over your skis, way ahead of yourself portfolio. And that's where people really get hurt. The balanced investor has to endure some pain, but the investor that gets overly concentrated, thinking that every new technology is going to grow to the sky, that's the investor that almost can't recover when there's a correction. And I think producer Chris is saying we wrap it there.
Yeah, I think that's perfect to wrap there. And so the point is, you can't become so myopic that you're only into whatever the hot flavor is at the moment.
Yeah, that's diversification gets thrown out the window there.
And so what I think where we both confuse people, but where we both come back to is, yeah, the market by historical measurements is overvalued. The question is what degree and which chart you look at. But the bigger thing is that people are putting themselves in danger by not following classic models of spreading out your risk.
Balance,
which allows you, when things are on the roller coaster, were you ever a roller coaster kid?
Yeah, I did them.
Yeah, I didn't like roller coasters because when my stomach would come, up into my throat, I didn't like that. And investors don't like that either. That's why you got to be diversified. So I know this was a lot of stuff winding around that Wes and I talked about, but ultimately
comes back to the basics.
Right. That right now, if you look at what you got and you're just way too much every latest AI thing you've heard of, that's too much risk. And that's why you need to do classic portfolio balancing. And you're saying also, you talk about powder dry and all that, a certain amount of money in cash so that you can have the patience to ride out the decline in a market and have money available that when the market does get really, really depressed and negative sentiment and all that, that you then at that point
could actually put money
dollar
to work.
Cost average in.
Exactly.
Yeah. So coming up ahead, we're going to deal with something that we're going to be really at opposite sides of the room.
Yes.
In fact, I'll go sit in the next county when we talk about this, and that's private equity.
Yeah.
Because that's something that private equity and 401ks
it's coming.
Scares the daylights out of me. And yeah, it's coming. It's that light coming through the tunnel. And it's not light. It's the train coming right at me.
You think we're going to get hit by the train? I think we can in some way hop on the train.
Well, that's what we're going to discuss straight ahead.
Welcome back to Ask an Advisor. I'm Wes Moss, along with the great Clark Howard. There was a comment this week on our private equity episode that said, Wes is calling Clark out on his own show. And before the break, you hinted to... Now, in fairness, I wanted to bring up the topic that private equity entering into 401k plans over the next, call it, couple of years is a giant change. So I think that's part of the reason I think I wanted to bring it up is that it's the first big change for 401ks since 401ks started. The question is it going to be good for investors? I think I try to have a balanced view on it. Private equity can be super risky, but I also think it could be a really good opportunity and open up a massive market that 99.9% of people haven't been able to participate out. But you have another thought or angle why it may not be a good thing in 401ks.
Yeah.
So you haven't told me yet.
Right. So private equity is such a big part of American capitalism and more worldwide capitalism. Yeah. Companies don't want to be publicly traded anymore. They're privately held. And this works great for Wall Street, the big money center banks in Europe and the U.S. and Asia. They love private equity. It can be more opaque. There's not as much disclosure what's going on. And when a lot of brokerages are pushing private equity, they're selling a lot of these blind pools where people are putting money in, big commissions, big fees. They don't even know what the money's going to be in because it's so magical. It's so secret. It's behind this curtain. And so what I'm freaking out about with it being in 401ks is one of the great things that's happened, and my hero Bogle is really one of the great influencers on this, is that today the ordinary investor, somebody who's working at a regular job who doesn't make a lot of money, can put money into this 401k, hopefully the Roth version, and because most people don't make enough money that it makes sense to be traditional 401k, and they can put money into a fund that has virtually zero expenses to it. So
Correct.
$1 invested, whatever it earns, almost all of it's going to them.
99.999% goes to work.
Right. But the problem with private equity is the commissions that the ordinary investor faces are humongous. And not only do they pay these massive fees up front, but then 20% of the profits that whatever they're in make are grabbed by the private equity player. And so, yeah, private equity at this point is probably bigger in American capitalism than publicly traded companies. But the deck always seems stacked to me against the small investor, which is why historically, going into private equity, you had to be a sophisticated investor who's wealthy already to go into private equity. Now you're talking about somebody who maybe is making $30,000, $40,000, $50,000 a year, they're taking hard-earned money and throwing it into this 401k, and they're playing with fire because the private equity thing is a whole different animal. And I have enough trouble explaining to people what the choices are, the plain vanilla choices in a 401k, because they're not normal investors. And then you're throwing this private equity thing on top where they say, trust me, this is going to be great.
Let alone Blue Owl Infrastructure 17 fund that we're going to eventually go build a bridge with your money. And you're right. So this is why private equity is, in some respects, it takes us back to 30 years when the only thing that we could invest in, or 40 years, were managers. Remember those days?
I do remember.
Hey,
expensive managers.
Peter Lynch. I'm choosing this fund because he's a good manager, and I'm putting money into this fund. In a lot of ways, not knowing what Peter Lynch will buy in the future.
Because he was supposed to be the most brilliant investor in the history of the world. And he was very good.
He was good. So the same thing with the popular mutual funds. I remember Bill Gross managing the PIMCO bond fund. He was just put money in the PIMCO bond fund because Bill Gross eventually will be buying the right bonds for you.
You were betting on the right jockey.
And it does take us back, Clark. Yeah. It takes us back 30 to 40 years when it comes to that kind of leap of blind faith, saying, now, in fairness, these funds that will eventually become a sliver probably of a target date fund is, I think, how they're going to work inside of 401ks. They are going to be, it's going to be a collection of managers that have done private equity probably for 10 or 20 or 30 years that supposedly, and we don't even know how this is going to be structured yet, supposedly have a good track record. That I think is what is supposed to happen. But to your point, there are a lot of things to worry about. The fees. Now, I've participated in private equity for many, many years, and I have noticed over the last 5 that the fees have come down. So it's actually a little more rare now to see a fund that charges 2% and then 20% of profits. That used to be the model, and there's still some out there like that. But just like with mutual funds, went from 2% to 1% to 0.5% to 0.1%, private equity expenses have been coming down because people are sensitive to it. So now it would be more common to see a private equity fund that's more like 1% or even a little less per year, or 10% of profits or 5% of profits. So I think the devil, though, will be in the details. How are we going to really access this? You bring up another good point, is that this used to only, private equity investing and venture capital investing used to only be for accredited investors or qualified investors. And these are people that have to have $5 million or more to even to participate. How are they getting away with putting private equity in 401k plans? The rationale is that the 401k plan is the investor. So that now they can own the private equity, and then the participants making $30,000 to $50,000 a year, they can participate. So
here's where I freak out. So you take the 403B plan, that the insurance industry has made the worst retirement plan in the history of planet Earth.
Because of expenses.
Expenses, commissions,
lockup,
conflict of interest.
Yeah.
And they are treating our nation's school teachers as cannon fodder. They're just exploiting them, cheating them, charging these massive fees to the point that a hardworking teacher trying to build up financial security for his or her future ends up with less money at the end of the year, even in a good year for the market, than they started with, because of all
the layers.
The layers.
7-layer dip of fees. That's what I...
And so that's where I fear here, because you're talking about something, private equity has always been kind of hidden behind a curtain. Right. And so that's what I worry about, is the lobbyists running this through the administrative process, because Congress, the president did the executive order, the Congress will pass whatever law, the administrative agencies listening, having their ears bent by the industry, by the big players, the big money crowd,
private equity lobbyists.
They're gonna do this in a way that the little guy is gonna get taken advantage of. And I would use stronger language. I would use stronger language, but this is a family podcast here.
It's a family.
And so that's my thing, is that you're a really sophisticated guy. You deal with wealthy people who have a lot of sophistication to them. They may have run their own businesses. They understand risk. And I really worry so much about what's going to happen.
The masses of America.
To the average American just trying to have a little piece of American capitalism and build up some financial security, that what you said, it's the devil's in the details.
Yeah.
I am going to be sitting here, let's see, are they going to 403B this, or are they going to Vanguard this?
Yeah.
And so there's a big range between the absolute terrible, horrific financial corruption of the insurance industry with the 403Bs and what they've done to our nation's teachers and people who work in nonprofits, and then what Vanguard and others have done to make investing fair for the average person. So that's why you talk about private equity. This is like a fire that I'm worried gasoline is going to be poured on people's own money.
Yeah, you're worried about the fox running into the hen house, and the hen house has been more and more protected over the years for the average 401k. It's gotten less expensive, more options, more transparent, better reporting and viewership, more technology around helping people plan within their own 401k. So again, if we fast forward a year from now or 2 years from now, and there's private equity as an option, and this is a good thing. These are going to be options within probably target date like funds, where if you're in a 401k plan, you can choose to one of the target date funds that likely has a sliver of private equity, maybe a big sliver, but it'll be your choice. And I think that's the good news here. I don't see the addition of private equity polluting the entire stream, because you'll now, you as a participant will be able to choose if you want to go into this, and hopefully we'll have the disclosures and we'll have the transparency to say, look, this is an expensive sliver. Do you really want to participate, or do you want to stick with more traditional models that are ultra low cost, which may still be the right path for a lot of folks? So we'll see. We'll see. I think the option will become available.
And see, here's what I think so important about us doing this is we did really confuse viewers and listeners. They were like, wait a minute. Listener watched Clark, and he says private equity is like the devil's workshop. And here you are saying, this is so great. We're going to have private equity and retirement accounts. And so private equity by itself as an investment vehicle is not an evil enterprise.
That's
some
correct.
of the ways some private equity firms treat the employees at companies that they acquire really badly.
Yeah.
But as an investment vehicle, it's not by itself a bad thing and it can be a good thing. The thing that is the gap between us is you're much more trusting than I am about how this would be implemented
and
for an
the whole
everyday
system.
person.
Yeah. You're worried about the entire ecosystem of retirement plans getting expensive, polluted, illiquid. I'm thinking
illiquid. See, that's a
can't get
big
to the
word.
money.
That's right.
Can't get to the money.
And it just explain for people who don't know, how long might they not be able to touch their money in private equity? 5 years, 10 years?
Traditionally, I'd say it's anywhere from a long time to forever. It's
Thank you. I just wanted to make that point.
It is. It's real. And again, that's one of the drawbacks. Now, it depends. There are a lot of categories in private equity, just like there are a lot of different categories of mutual funds. The traditional, what I would call old school private equity, is a very long cycle because, again, to your point, you blindly put money into a manager who has a track record of buying private companies. It takes forever. It might take 3 years for the fund to even buy the companies. So that's 3 years. Then it takes another 3 to 5 years to make the companies more profitable. So now you're at 7 years.
Or bankrupt them out.
True. Or 8 years.
Now
we're 8 years in. And then think about how long it takes to sell a company that's $100 million or $200 million or $500 million private company. Well, that takes a long time to find a buyer. So that could take for them to buy all the companies they want to buy, then turn them around, then sell them. That's where you get these 10 to 12 year lead times. And
Where somebody with normal investments in a 401k can change their allocation tomorrow.
Every day, tomorrow. Right.
And so I'm not sure that the average person in a 401k has
ready for that
any
kind of
idea that they would put money in, and by the way, they can't see that money again for 12 years.
It's a long time. Now,
Yeah.
there are now a lot of other layers and versions of private equity that are much shorter. That could be what they're looking at doing are these open-ended private equity funds where money comes in, they're buying a company. It's not a closed fund, if you will. What they're trying to do in the 401k sense is have just a running fund, almost like a mutual fund. Money goes in, they buy a company, and they may be selling a company a year later, so there may be more liquidity. It still remains to be seen how it's implemented.
Right.
It really is going to be about the details. It'll be about the disclosure. It'll be about the transparency. And it'll be about the fees. And we'll see. Does the whole system, the ecosystem, get polluted? I would say I see where you're coming from. I'm going to remain positive and say that it does not. I think it's going to be a benefit. But I'm going to be watching real close, Clark.
And I hope you're right. You know, the negativity that you're hearing from me is based on history. And I get so upset about people who get taken advantage of, who don't have a lot to start with, and they get rooked.
Yeah.
And they come into this in a 401k. You know how most people figure out what they're going to put in their 401k?
They look at the 3 year rate of return.
No, they ask, hey, you know, that guy, Jim over there.
He knows money stuff.
He spends a lot of time fooling around with investment. Hey, Jim, what should I put my 401k in?
Yeah.
You would not believe how much it's like that.
Yeah.
I mean, people aren't looking at charts like you're talking about.
Yeah. You're right. Well, I think the jury's still out. The other thing, too, though, is that if you look at how the statistic is that 89% of businesses, large businesses in America, defined by $100 million of revenue or more, that's considered large. Almost 90% of them, 9 out of 10 companies in America are private.
Right.
So why should just the 0.1 percenters be able to access that when the other 99.9 can't? And the 0.1 is saying, well, I'm doing this because these are 15 to 20% returns per year. Like, why should only the 0.1 be able to get that when everybody else gets locked out?
No disagreement at all.
Yeah.
The problem, as you've said, and as is so clear, is how's this actually going to play out? And that's my fear. So I love that we did this, because if it helps you understand that we don't disagree that private equity is and privately held companies are obviously
Could be
a
a good
key
vehicle.
engine of
Yeah.
worldwide capitalism. It's for a small investor. This could be, depending on how it's done, a stacked deck up front against you based on lack of disclosure and fees, and also have restrictions like having to hold something for a long, long period of time that would make this bad ugly for a regular small investor. And so that's really where I come at it so negatively. And I do have a beef about how a lot of these private equity companies really harm the employees at the companies that they buy.
Yeah.
That it is, I mean,
It is brutal.
it is take no prisoners
It is.
capitalism, and it is mean-spirited towards human beings.
It's the last thing you want to have happen is a private equity company buy your family culture wonderful company, because it will not stay that way.
But that's a thing about humanity that I always worry about. But in terms of money, if you look at capitalism as just a pure event, obviously private equity is ultra important and meaningful for investors. It's just how this is going to play out for everyday people. I'm freaked out.
We're on watch.
Well, thank you so much for letting me be a guest on your podcast.
This is so much. Don't tell Krista that it's so fun to have you here. Because we get a lot of
people miss her. Hey, Krista, can you just come in and wave? Because everybody really wants you here, not me.
Not true.
Here she is.
Great job, guys. Great job.
Thanks,
you.
Krista.
Okay.
Thank you, Clark.
It was great.